All right, today is Thursday, June 16, 2022, and it's time to do a quick update on the $1 million portfolio. So the $1 million portfolio is down about 8% this year. So we're sitting at $920,000 as of right now. So this is pretty current. It's time for me to make my monthly buy-in into this portfolio. So in recent weeks, inflation is continuing to rage, and this has forced the Fed to raise rates by a lot higher than they were planning to. And that's got everybody rattled, right, for a variety of reasons. But for me, before I get into some of my thinking on what's going on, with current conditions, for me, I have a plan, and I'm just going to go and execute this plan, which requires me to buy in to my positions at $30,000 a month. So I'm just going to keep on buying that. Right now I have cash of about $470,000. And I'll just keep doing it. So the buys for this month would be into the NASDAQ 100 Trust, the QQQ, long-term treasuries, which is TLT, and then some gold stocks. Not gold stocks, but gold ETF. So let's get right into it. So the first buy will be 84 shares of NASDAQ 100. That's going to be about $23,000. I already have the order queue up. We'll just go ahead and review and get it placed. All right, that order is placed. So we're going to move to the next position, which is about $5,500 for TLT, long-term treasury. So that's going to bring us 23 plus 55. It'll bring us to 28.5 for the buy. So I'm going to go ahead and review the order. Oh, trading system is unavailable. So let's go and try this again. All right, review. There we go. Place the order. When I get an error like that, especially in these times of volatility, there's always a pause where you get kind of concerned and kind of thinking about what's going on. Why is it not available to trade for whatever reason? But sometimes these things happen. So the last buy we're going to buy for today is about $1,500 worth of the GLD, the gold ETF. So that should bring us to $30,000. So let's review this order. And on this particular one, I'm actually getting a little message, which is actually kind of new. I haven't seen this one before, but it's basically just telling me that this is a commodity and it may be extremely volatile, whatever. I'm not worried about this particular issue. I think it is a commodity, but it's quite liquid. There's a lot of activity in it. The volume, even as of today, is 6.5 million shares. So I have no problem buying and holding this. So I'm going to place this order as well. All right, the order has been placed. So if I refresh this page, what's going to happen is that my cash to invest should go down by about 30,000. So we should see this drop to 440. And market value for the shares should go up to about 480. So let's refresh, and we'll see all of these positions increase accordingly, except for the REIT, the real estate income one. So let's refresh, and we're down to 440, and equity value is now up to 480, and all of these positions are now increased appropriately, and we're done with the buy for the month. So in terms of what's happening, yesterday, Wednesday, the Federal Reserve had their FOMC meeting, which is the Federal Open Market Committee meeting, and they decided to raise rates by 75 basis point, which is 0.75 or 0.75%. This is a much bigger increase than they had planned, which was around 0.5% or 50 basis point. And it's a big increase for over 30 years, I want to say, or roughly around 30 years. I don't remember the headlines exactly, but they're doing this because the inflation report that came out on Friday was showing inflation as really strong, 8.6% or something like that. And they feel like they have to play a bit of catch up. And this has caused markets to just kind of go nuts, right? Because whenever you have a rising interest rate environment, the theory is that your equities are going to suffer. The returns on them are going to go down. So everybody reacts accordingly. So if you were to look at the S&P 500 year to date, I think it's down something like 22.5% year to date as of today. And if you were to look at the NASDAQ 100, which is kind of like the S&P, but it's more growth stocks. There's a lot of overlap, but it's a lot more growth stocks in the NASDAQ 100. It's down something like 33% year to date. So both of those markets are clearly in bear market territory, which is defined as a drop of 20% or more from the most recent peak. And both qualify at this point. I think for a while, the S&P 500 was just right outside of bear market, but there's no argument now that both of these indexes or indices are trading in bear market territory. And people are freaking out. If you read the headlines, you can see it. Everybody's talking about recession, and yes, we may have one. I don't, deny that. But everybody's talking about it. Everybody's thinking that, the Federal Reserve is not going to pull off a soft landing, which is what they like to do. And they may very well not, because I think they've only done it one time in the past during Alan Greenspan's tenure. So the track record is not great. But the point to remember is that when people are panicking like this, talking about doom and gloom and things going down and the outlook looking bad, and everybody's having the same reaction, this is precisely the time that you want to be buying. Now, should you buy everything at once? That depends on your comfort level. For me, I have decided, and I decided this a long time ago, to buy in small increments of $30,000 for this particular account. For the broader portfolio that I'm holding, it's roughly along the same magnitude because I still have, a big cash position in my overall portfolio. It may be a little bit less than 30,000 or 3%, which is what 30,000 works out to be. I think like on the broader portfolio, including this account, I may be targeting something like 2.5%. But the point is not the amount necessarily, but that I have a plan, I wrote it down, and no matter what happens, I'm going to execute and carry it through. The other thing to remember is that the market will have cycles, right? If you are looking broadly at stock returns, it's something like, in any 10-year increment, you're going to have 8 years where the market is going up. Well, if that's the case, I'm going to give you one guess as to what the market's doing the other 2 years, right? It's going to go down. It's the normal course of things. Sometimes it only goes down by a little bit. Other times it goes down by a lot more. And it's whenever we get these going down by a lot more that people start to panic and just go crazy, right? If you're in individual stocks, there is reason to be concerned, especially if you're buying into the hype, buying these meme stocks, whatever the case may be. But if you have, broad indices, S&P 500, NASDAQ, total stock market, whatever the case may be, you're going to be fine. And I wouldn't worry about it. The biggest thing for most investors is their own emotions when they're investing, right? To be successful in investing, you just have to kind of forget your emotion, as hard as it is to do, and just approach it in a very mechanical manner. And that's why I keep talking about, if you watch these videos, I keep talking about having a plan and executing it. And if you think about what I just said in terms of, the markets have these up and down cycles, but in the long term, it's mostly up, right? You would want to be buying when you have these big dips in the market. And in fact, if you are at the beginning stages of your accumulation of wealth, you actually want to be in an environment where market returns are flat or even slightly declining as you add in to your nest egg, on a regular basis, whether that's monthly, quarterly, whatever the case may be. You want to be buying when the market's flat or slowly decreasing as you're accumulating these assets. And then what happens is that when you are close to having the nest egg that would allow you to get that financial independence, whether that means retiring or whatever the case may be, it'll revert to the mean. So this is a term in statistics where, things will kind of go back to what they're supposed to do on the long term. So if stocks have been going down, but in the long term they will go up, that means that at some point the downturn will reverse and things will start going back up. If you had been buying when things were declining and holding all these assets and rebalancing as needed on an annual basis or whatever makes sense, when the market inevitably turns around, you're going to be in a great position. So if you're buying and investing on a regular basis, you want the market to be kind of flat or even going down. So what's the point? Point is not to panic, right? And for me, I'm not panicking. I'm just going to keep on doing what I'm doing, and there will be light at the end of the tunnel. So I think this year is particularly kind of crazy for the first half so far. Hopefully things will improve in the second half, but no one really knows. You see all these talking heads on TV and the newspapers, whatever, who will make predictions. But the honest truth is they don't know what the hell they're talking about. Okay, so-called experts and all of that, it's all just noise. You should forget the news, have a plan, write it down, and just follow your plan. I mean, if I were to look at some of these numbers, down almost 4% on the NASDAQ today, 3% on the S&P 500, things look bad. And on a year-to-date basis, it's even worse. So you kind of look at it and you kind of go, wow, the sky's falling. Well, not really if you have a plan. This is actually the perfect environment to pick up assets because you're going to buy them cheap. So keep on accumulating, and thanks for watching. I'll be back at the end of the month with kind of an overview of the account, and then I'll be back mid next month for a $1 million portfolio update. All right. Thank you, and hang in there. See you later. Bye.